So welcome everyone. I apologize for being 5 minutes late. I don't even have a very good excuse. I have a new cell phone and I didn't realize I can't hear the alarm. It's not loud enough. So I overslept by 10 minutes. I'm really excited to be here today and to have you all. Hi. Come in. Okay. So what I thought I would do is just briefly introduce myself before we begin, and then also just explain a little bit about how the course is going to work in terms of how your material works. The textbook, which is quite big and quite intimidating in terms of size, but we won't be going through all of it, so don't panic. And just the assignment and so forth before we actually go on to the work itself. Okay. Obviously you guys know each other sort of by now. You've done a couple of modules together. So I'm not going to get you to introduce yourselves, but hopefully I will get to know you a little bit better as sort of time progresses and as the 2 days progresses. All right, so my name is Janine. And in fact, if you need to contact me, there are my contact details. That's my cell phone number, and that is my email address. So what you will find is you can write that down. Let me just say no to this, it's automatically connected to the internet. What you will find is you've been given a course manual. And that course manual actually begins with your post-modular assignment, and just after that, will be after the page in blue. You'll actually find that there is a series of slides. Now, they're not all the slides that we're going to be looking at, because a lot of the slides actually maybe duplicate something, an exercise that's in your book already. Then I'll just give you the page number or something. But where there's not a duplication, I've taken the time to ask them to please print it. So if you turn to slide 2, you will find my details there. But it's not a bad idea to write them down in the front of the book, because you always forget where in the book they are. Right. And I must just say that if you are going to contact me by email, I've had 1 or 2 students actually say to me that they sent me an email and I don't remember receiving that email, and I've actually started checking my spam, and I think 1 or 2 things are being delivered to spam. So to be on the safe side, it is your responsibility to nag me. I don't mind being nagged. If you have tried to contact me and I haven't responded to you, it's your job to nag me and contact me again, please. Because I do want to hear from you, and I do want to be able to help you with whatever needs helping with, right? All right, so if you need to actually contact me, those are my details. As it says there, my name is Janine Blignaut, and I have been a facilitator now probably for about 16 years. I know, long time. Although what I find is that it's quite interesting is I actually have a BA and an honours in psychology, and yet here I find myself teaching accounting. But I think maybe it's because I love to teach accounting. I love to teach, actually. And it just so happened that I got into the teaching of accounting, and I find that I quite enjoy accounting as well. So that's an odd thing. But anyway, I also have a BCom as well that I am trying to get UNISA to sort out the final credits now, but UNISA is not quite always what it used to be, so that admin is taking a while. And I find that what I do occasionally do is actually take on work as a bookkeeper or as a financial person, just to kind of keep up to date, so that the lecturing is more meaningful. So I'd probably say that in those kind of 16 years, probably about 80% of that time has been in training, but 20% has been in taking short assignments. The last one that I actually did was quite a while back, was about 2 years ago. I took on the financial management, was on maternity leave, so during the audit for the 4 months that she was gone, I actually helped them to deal with the auditors and do the financial management. So I do, even though this is my lecturing, I do have a bit of sort of experience in the field as well, quite a bit of experience. My dad is also an accountant, an accounting lecturer. and the brother is an accountant. So I think maybe it was genetic destiny that I was sort of cursed never to become a psychologist and to end up with accounting. All right. Okay, so what we're going to do is I'm briefly going to give you a course outline. It's actually in the slides. But what I'd like to do now is, hi, come have a seat, is discuss the course material. I don't think you have a textbook, do you? No. And is your name Portia? Yes. Okay, great. So you're sitting where your name tag is. That's excellent. I'm going to give you one. I'm going to get from Trish and Nana. But, did you take one for him? No. No, that's yours. Okay. But don't panic. We don't need it at the moment. So we'll get it for you a little bit later. You're going to get two things. One is your course manual, or what we like to call, what is it, the participant's guide. Yes. We like to refer to it as the participant's guide. And of course, you're also going to have this textbook over here. Right. Let me just get mine out. Mine looks a little bit different from yours because mine's the previous edition and the accountant and me can't bear to have two of the same because it's wasteful. And really only the page numbers have changed slightly. So, but you have the later edition. So what you're going to find is that if we have a look at this textbook, we actually go through to the introduction, there'll be a brief contents section, there we go. All right. And you will basically see that it's made up of 12 chapters. It's right near the beginning. It's almost sort of the second or third page, actually. Yeah. So there are 12 chapters, and there are a good sort of 565 pages worth. So that might feel a little bit intimidating for you. But a good 100 of those pages are just appendixes and indexes and so forth. And we also just want to explain the rationale behind this textbook. This is obviously the only accounting sort of module that you're going to be doing in your degree. So what we really wanted to do is we had a bit of a dilemma was, do we use a South African textbook? Do we, use an international textbook? Also, even though we call it financial accounting, accounting is really broken up into financial accounting, cost and management accounting, and financial management. Do we aim it at, do we use a textbook that is based with, for accountants or non-accountants, et cetera, and we looked at the whole stream of textbooks and we came up with this one and we liked it because the purpose is we will not be going through all of this. It's far too large a book for the time that we have available. Probably of the 12 chapters, we will go through about 5 of them, all right? And what you will find is in your participant guide, if you need to go through pages in the textbook, it will actually refer you to the pages that you should read. But we like this textbook because we thought that you could use it. It's international. It's written in the UK, and the UK uses quite similar standards to South Africa from an accounting perspective, or at least very similar language. If we'd chosen an American book, the language is almost, it's quite difficult. They don't call shares, they call them stocks, and just, the terms they use for capital and that are quite different. But here, it's also written for an international market. It's well supported. There's a little website. You'll actually find that there's a little, at the back, mine's come out, but at the back of your textbook, there's actually a little envelope, yeah? And if you open that up, there's a code, all right? What resources support the book actually change. In the past, they had 1 or 2 sort of short 5-minute videos, which was quite a nice little feature. They don't seem to really have that anymore, but they have tests and assignments and little, definitions and that sort of thing. So you're welcome to go through that if you like, if you want to. So the main purpose behind this was that we liked that it actually was aimed at non-financial people, all right? B, it's nicely divided up into, it covers a little bit of financial accounting, a little bit of cost and management accounting, and a little bit of financial management. And what we liked about it was you could use it as a reference whenever you maybe have a finance-related question during your degree or something like that. So we felt rather than just write a manual, it would be nice to give you a good textbook, all right? And so I don't want you to be overwhelmed by the textbook size in any way, shape, or form. All right. And it's a good book. I like it. I think it's one of the better books written for non-specialists. It's quite difficult. We accountants like to, I don't know what it is, if we can say something with one word, we believe it's better to use 2. or 3, maybe 4. So, you know, it's quite difficult to find a good text when it comes to finance. I think you probably find that with anything in business as well. We do tend to, I think it was Mark Twain who said, I didn't have the time to write a short letter, so I decided to write a long one instead. To get to the point is often takes a little bit more time than to, yeah. Okay, so that is the textbook. And we probably won't use it today, but because I do want you to almost interact with it in some way, what I've done tomorrow is we'll actually use a couple of exercises out of the textbook. And, you know, in the textbook, in the guide, it says, let's go to this page, etc., etc. So it's worth bringing them tomorrow, even though we won't really be using them a lot today. And they are good books. All right, so then I'm going to introduce you to the participant guide. And the participant guide starts with the assignment. Now, the assignment for this particular course works a teeny bit differently from your other assignments. There's no different in terms of submission dates and not negotiating, or rather, consulting with your CAM and so forth, etc., etc. What is a little bit different is this is not going to be an essay type assignment. We've tried very much to make it practical. So I've broken it down into 4 sort of quite practical questions that you need to answer. And if you actually have a look, which is, I think it's page 3 of the book, 3 of 11. If you look at the content application, all right, there are some profit calculations and the accounting equation that you're going to do in the first question. You're going to do financial statements and ratio analysis in the second question. And you're going to do an income and expense budget and a cash budget in the third question. And then there are going to be some sundry questions in the fourth question. All right. There is a little bit of theory, okay, but those are kind of short questions like explain a fixed cost to me or explain a variable cost. So I don't want an essay. If I have sort of given it, if it's maybe out of 3 or 4 marks, then I probably expect you to maybe write sort of maybe double that in sort of lines if it was handwriting. Maybe if it's, you know, 3 marks, maybe give me sort of, I don't know, 4 or 5 sentences, you know, to explain that. So I'm not looking for an introduction, I'm not looking for a conclusion. You don't need to reference unless, of course, you are, for some reason in your short theory question, taking an idea from a book where it does need to necessarily, you know, you're taking it in such a way, not all ideas necessarily, but if you're taking it in such a way that it needs to be referenced, you can still obviously reference at the back, but it shouldn't be necessary to do referencing. Okay. That also brings us to the issue of how you submit it. I need it electronically, so you can do it on Word. I find that, sure, that's quite a bit of typing actually. So Excel is fine with me as well. But if you're not an Excel fundi, I've actually said, I mean, usually sort of, we don't do this anymore, but I'm actually quite happy for it to be handwritten. As long as it's relatively neatly handwritten, I have no problem with that because you're actually going to do the question where you're going to maybe do an owner's equity or you're going to do an income statement, and I really don't see why that's necessarily a problem. In fact, in some respects, it's quite nice because you're actually physically sort of connecting with the work and doing it in that way. So I really don't have a problem with that. The only thing is that it needs to come to me electronically, so you would need to be able to have access to a scanner and then obviously scan that up so that you can then send that to me. Just in terms of you guys sort of plagiarism and that sort of thing, I also want to point out that I don't have a problem with you working with your, hi, come and have a seat. Is it, your name is? Hi, Rafilwe. We're just having a look here at the moment. Okay. My name is Janine. I don't have a problem with you, for example, because it is an assignment, all right? So you are supposed to consult sources to help you find out the answers. And I don't really have a problem with you sort of working in groups with other students, that kind of thing. What I do have a problem with is what I have found is happening, or can happen, is let's say you sit down and you work together and you then type up one answer and then submit that. I have a problem with that. I have a huge problem with that. To me, that is no longer, I no longer know that both students had engaged in that process. So if you work together, then work together, write down your answers, even if they're very similar. When you come to the process of typing it up, you will make slight differences, I can see, even if it's spelling differences and that kind of thing. And, I can treat that as your own work. Whereas if you don't do that, you put me in an ethical dilemma. And, while I have no judgments, we all make mistakes in this life. As a lecturer, I will not mark that. You will have to redo it. Or you may even get into, if it gets reported, I don't know what the procedures are at Da Vinci. So please do not do that. Also, I often remember, so even if you submit at other times, if something strikes a chord for me, I will go back and I will look at the last batch. Just changing the font won't work. You'll make the same spelling mistakes. I will pick it up, etc., etc. So please don't do that. And the reason that I insist on it is A, because this is, at the end of the day, an individual assignment, and B, because if you work together in groups, often what happens is maybe one of you is stronger in that particular area than the other person. And requiring that you go home and sort of rewrite the answer may seem, well, what's the point? But it's amazing how you then engage with it and actually understanding comes from you in a way that wouldn't if you just, got the stronger student to type something up and you both submitted it. So, like I said, I don't mind finding similarities in answers because people have consulted with one another, because it is an assignment. You're supposed to be able to consult. You need to find out. It's not a test, but I do not want the same sort of, it's just, even if you maybe have written up one answer and you decide to handwrite it, you need to go and rewrite that and rehandwrite that. And I can assure you that when you do that, you'll make slight changes here and there, and it won't be exactly the same as, the other person's. All right. So please bear that in mind. So what that means is that in terms of the presentation mark that you get, that's not really going to apply in this particular assignment because it is going to be sort of practical questions. However, that still means, even if it's handwritten, I want it reasonably professionally presented. Do you know what I mean? So make it as neat as your handwriting allows. Have a cover page. Just do it, reasonably so it's at a decent standard, so to speak. But it doesn't mean that there will be specific points awarded. Right. So if we turn the page, we go to page 4 of, no, not 4 of 11, we go to page 6 of 11. Maybe you can just spend a moment or two just having a look at what kinds of questions are actually asked. Now, what we will do is we'll find there's 4 questions. By the end of today, you should be able to answer the first 2 questions. So what I suggest we do is, because this is not really going to make the most amount of sense to you now because we haven't done anything here, I'm not going to discuss it now, but I'll come back at the end of the day and show you how you could do both of those questions. And then by the end of tomorrow, you should actually be able to do the other 2 questions. So let's leave that for now, and let's go on to the slides. And let's look at our course outline. All right, so what we've got planned for this morning is we're basically going to do some introductions to some basic accounting principles, all right? So we're going to talk about the purpose of accounting and the main uses of accounting and et cetera, all of that kind of stuff. What to me is important is that what we'll be defining is the assets, liabilities, income, expenses, and capital and reserves of a company. What we will basically be doing this morning is introducing you to what it is that the accountant is about, or accounting is about. And we're going to discover that it's about establishing the value of our assets, our liabilities, our income, our expenses, and our capital and reserves, and how we translate that into something called the accounting equation, which is really a record of where a business has sourced its funds and how it has used its funds and how that accounting equation actually becomes the basis for the balance sheet, which is one of our financial statements. We're also going to be explaining the difference between net profit and how we go about calculating it, and net worth, and we're going to look at the effects of financial transactions on the accounting equation, in other words, on the ultimate balance sheet that the business draws up. Now, we're going to also do something in that we're going to discuss the double entry rules, the rules of debit and credit. Now, it's interesting that there are two schools of thought about whether we should teach the rules of debit and credit, because the debit and credit system was developed in the 16th century, and it's been very useful, and we've used it ever since. Accountants still use it, they love it, but some people have pointed out that you could actually do accounting as long as there's a principle of double entry. You don't necessarily have to have that as a debit and as a credit, and so we could actually quite adequately teach accounting without debits and credits to non-specialists, because it actually is just a confusing process for them. There's another school of thought that says if you are going to, even if you're a non-specialist, learn about accounting, you should learn about this because it's used all the time. And for you to have an understanding of what is meant by it is actually very, very important. So what I've decided to do is, I'm of the school that I think it's very illuminating and interesting to discover what is a debit and what is a credit and what the accountant means in order to be able to have that conversation. So the textbook takes the approach no debits and credits. They don't even discuss them really. However, there is a little extra reading handout which is in the participant guide which explains it to you, and I'm going to explain it to you, and we're going to do an exercise. In the assignment itself, there's no debits and credits. There's indirectly debits and credits. We'll look at the accounting equation, but in fact, I've taken out even the little column that says debit credit. It's just accounting equation. You can just do it without actually reference to debits and credits. So there is no debits and credits in the assignment, but I think it's meaningful and useful for you to understand. We'll give you a brief overview of what the accountant does in terms of journalizing and ledgers, but it really will just be a 10 or 15 minute discussion, because at the end of the day, we're not trying to turn you into bookkeepers, we're not trying to turn you into accountants. We really are trying to give you some sense of what accounting involves and some of the more important ideas, so that you could possibly have a meaningful discussion with your accountant or participate in the budgeting process perhaps in your work environment, etc., etc. So that's what we've got planned for this morning. Okay. I'm not going to bother to go through in any real detail, because we can do that as we go through it, but this afternoon we're going to really sort of move on to the idea of adjustments and financial statements, and that's the income statement and the balance sheet, which nowadays is often referred to as, does anybody know? What's the new fancy term for income? It's often called the statement of comprehensive income. Right. And the balance sheet is now called the statement of financial position. Yeah. So, but we'll discuss those kind of names that are often used. We'll be having a look at those. Then tomorrow morning we're going to be doing financial ratio analysis, and then in the afternoon we'll be looking at a bit of information relating to budgeting. Okay. But really the main sort of form of this course, or idea behind this course, is getting you to understand what's in an income statement, what's in a balance sheet, how we can analyze those with ratios, and how we can actually budget for those as well. So that's really the main idea in this course that's important for you to be able to understand. All right, so let's all begin. If I ask you what an asset is, all of you will come up with a slightly different definition. Same word, slightly different sense of what it is that it actually means. So the thing is that none of your definitions is necessarily incorrect. It's like me saying to you, what is love? Right? Everybody's going to have a slightly different definition. So that makes it quite interesting, because you and I can be having a conversation about love and we think we're talking about the same thing, but we're actually talking about something that's a little bit different. And so miscommunication comes in, etc., etc. Now, the same obviously applies to accounting terms like assets, expenses. They're used in everyday language. They can be used slightly different if you are in an economics course than if you are in an accounting course. You may have your own personal working definitions of assets and expenses. The thing is, what accountants said is none of that is incorrect. But as accountants, we need to find a way to speak a common language so that if we get together and we discuss an asset, we know, we're sure what it is that we're actually talking about with one another. So it's really interesting when you get to adult learning and the kind of learning that you are now doing, and you compare it to how you learned at school. I don't know if you know, but most people, in fact, we kind of think as we get older, our intelligence sort of gets lower and lower and lower. And in fact, they've done some IQ tests and followed people over the years, and they found on average that's not actually true. Our intelligence often changes, but it doesn't mean that our IQ actually gets lower. In fact, what they find is the average pattern is for it to almost rise up until you hit about 40, and not for every person, for some people it continues to rise. Then it tends to stabilize until you hit about 60, and then you do sometimes experience some drops, but it's not like a drop like this. But the interesting thing is there are two types of intelligence, and I may always confuse the names of the two, but the general idea behind each is the same, which is crystallized and fluid intelligence. And when we are young, our fluid intelligence actually peaks, which is basically our ability to learn something from nothing. We don't need to know anything about it in order to be able to learn about it. That kind of peaks in your early 20s and then it levels off. Unfortunately, that does seem to decline. However, our crystallized intelligence, which is where you actually take previous experience and use it, makes up for that. And we use that as building blocks for new learning. And in fact, that means that our IQ can very well actually increase over time. But what it also means for adults is that if you tell them something that interferes with prior experience, there's a tendency to want to reject it because you can't build, because it doesn't work. So I want to point out that some of what I may tell you may actually differ from your experience. It doesn't make your experience wrong. It doesn't make your definition incorrect. All we're trying to say is contextually within the field of accounting, what does this mean if we're going to speak a common language, all right? So if for you an asset is, I don't know, whatever it is, it can continue to be that. That's a working definition that's gotten you this far in life and you all seem to be doing quite well, that's fine. But it doesn't mean that when you chat to an accountant, he's necessarily going to agree with your interpretation of an asset, or in terms of whether it should be debited or credited, etc., etc. So we're trying to teach you that global language of accounting, all right? So what we want to do is we want to talk about what I like to call the big five, all right? Because to me, that's the heart of accounting, all right? So if you were a hunter and you went on a game expedition, you would search for what would be the big five. I think it's your rhino and your buffalo and your lion. I like to think of it as your 5 Mandelas because he's on all our money now. Because I can never remember the actual 5 animals. But anyway, so we'd be searching for those big 5, wouldn't we? So the point is that as accountants, we're kind of nerdy. If we were to go to a game farm and we would be on the lookout, what we would be on the lookout for is a business's assets, its liabilities, its capital and reserves, its income and its expenses. And that is really what accounting can be broken down into. It's an attempt to actually find out what the value of that big 5 is and also control its value. Okay, that's where management accounting comes into. And essentially what we do is once we have those big 5, we can combine them into all sorts of things. We can combine them into the income statement and the balance sheet. We can analyze how well we did in terms of those big 5 with ratio analysis. We can budget for those big 5, all right? Or aspects of those big 5. So that's what we want to discuss this morning. All right, and we want to discuss how those 5 can be combined into something called the accounting equation, where we're able to establish a business's assets and how that equals back to the equity of the owners and the liabilities. All right, obviously assets are assets and liabilities are liabilities, but we'll find that the capital and reserves, the income and the expenses can actually be further combined into this idea of equity. All right. So that's really our starting point for this morning. So now you can either, if you want to, look at the next slide, or it's just really there for you. I find that sometimes to actually participate, it's nicer not to have the slide in front of you, if that makes sense. Obviously, it's up to you what you do, whatever suits your learning process better. But often I ask you questions where the answer is actually on the slide, so it kind of like defeats the purpose of getting or generating ideas. So it's up to you though. But in terms of these definitions, you may wish to just ignore those two slides. Okay, so the first big five that I'm going to discuss or start with is the idea of assets. What are assets? Yeah.
Anything that can give you income.
Okay, anything that can give you income. I like that. Anything with a value, okay?
An asset is a resource controlled by the entity
Okay.
as a result of past events and from which future economic development.
Yeah, no, it's the formal accounting definition for an asset is, well, let's remind myself again, it is a resource controlled by the business arising as a result of past events from which future economic benefits is likely to flow. And that's a great point. Okay, I'm going to break that down into English. It actually breaks down into 3 points, which are actually quite straightforward. And the interesting thing is all of this is true in many senses. But to the accountant, some of this is true and some of this is not. I don't know if you've ever read Rich Dad, Poor Dad.
Yes.
Okay. He would love this one as a definition of assets. In terms of actually the ability to make money, it's really nice the way that he defines assets versus etc., etc. But to the accountant, that's actually not necessarily just true of assets. It can be true of expenses too. We'll actually discuss that. So from the accountant's perspective, it needs to meet 3 criteria. Firstly, it needs to be something that the business owns. Okay? So assets are possessions, or as you say, resources. All right? Okay. Secondly, let's try something. I want to tear up something that's not so valuable. Oh, let's try that. Let's try that. Okay. This is my piece of paper. It belongs to me. Right? So it is something I own. Is it an asset? Could be, but is it a financial asset? Why not? I own it. I've just said assets are things the business owns. Okay, so you are quite correct. Assets need to actually be things we own that have a value. And the value has to be quite specific. In accounting, we only really assign money value to things. So basically what I say is it has to have some sort of retained value, but I need to be able to express that realistically in some sort of fair money amount. So what often happens in accounting is we often think accounting is the be-all and the end-all, and often accountants think accounting is the be-all and end-all. But in fact, if an asset can't be realistically given a monetary value, an actual rand and cents value, we don't necessarily bring it onto the balance sheet. It's one of the limitations of accounting. So certain things that we might every day in terms of it's positive, it's, you know, we think of an asset as something that's positive, are not necessarily actually just brought into the balance sheet or shown in the balance sheet, because the balance sheet is expressed in rands and cents. Okay. So what this means is that they have retained a money value, and because we can put a rand and cents value to that, it means that they're either cash or they could be converted into cash. They don't have to be converted into cash, all right? But the point is there is that possibility. So if I buy these desks and chairs, I may not have cash, but what I have is I have something I own which has a retained money value, and if I wanted to sell these off and get rid of them, I could reconvert them into cash. there's this idea of retained value. Most of the time I'll probably just use them in the running of the business, but the point is it has that ability, all right? It has that value. And that is quite correct that you now, so you said it was something that's owned. Interestingly enough, that idea of past events I haven't necessarily brought into, but there is this idea that assets should have cost you something to actually buy if you're going to bring them into the balance sheet. But I'm not going to go into that one into too much detail. What that makes is it makes assets the current, or perhaps because you get current and non-current assets, just from an English perspective, maybe I should have used the term present. It's existing in the now. They are the present resources of the business that can be used in the future running of the business because they have not yet been used up. They still have their value, so to speak. So I own them now, but that means I can use them in the now and in the future in order to help generate profits and just run the business as a resource. Yeah.
So
Now,
can I
yes.
just ask you a question? When you say
Yes.
own, I'd like to think it's something that you don't owe money, like you still owe the bank.
Now that's a really interesting question. Certainly from the perspective of, if someone was teaching you about money, you would say, oh gosh, an asset that you still owe money on is not really an asset, and that would probably be a good financial principle to consider. But in accounting, we actually consider if you own it, then it's your asset, all right? It doesn't matter whether you owe money or not, because we have this idea of assets equals equity plus liabilities. So we will be able to break the asset down into the portion financed with liabilities and financed with equity. And equity is considered the real worth to you. So let me give you an example. Let's say I buy a house for 100,000 Rand, okay? And I finance that fully with a bond. What do I have? Do I have an asset or a liability?
Yeah, the asset ability.
I actually have both, all right? On the one hand, I own a resource and its value is 100,000, land and buildings, all right? And I need to record that. On the other hand, I have a liability attached to that called the bond for 100,000. And that means when I do that accounting equation that we looked at previously, I will figure out that the real value is essentially zero to me. Okay, that's what equity is made out of. Because at the end of the day, what I owe the same amount of money on that. But from a perspective of wanting to look at the balance sheet, I want to be able to see all available resources, and then I want to be able to see what was financed or is internally sort of allocated to the owners and what must be repaid in terms of outstanding liabilities. So we would consider any asset, regardless of whether it's an asset bought for cash or on credit, we would consider it to be an asset. The only difference is that if it was cash, it would result in a decrease in our one asset bank and an increase in our other asset, whatever we're buying. Whereas if it was financed through credit, we'd have a growth in our one asset, but we'd also have a growth in the liability. And remember at first that idea of what's the difference between the 100,000 and the 100,000, the land and buildings and the bond. At first they look exactly the same, but over time the difference becomes quite clear. So let's say, for example, that land and buildings that you own, let's say that asset, its value grows over time, which is quite possible, all right? That would affect the land and buildings account, but it wouldn't affect your bond account because you don't owe any more. That bond account is specifically to show what you owe. As you repay that money, that'll affect the bond account, but won't necessarily affect the value of the land and buildings in your books. So we're going to actually, one of the things we're going to be learning about is the idea of a double entry. In fact, for every transaction, what a double entry involves is saying, where did the funds come from and what did I do with it? So in your example, the fund came from the bond. What did you do with it? You used it to finance an asset. Right? That's what accounting is actually all about at the end of the day, is to actually, where did I source my money from? What did I do with it? And the reality is those big five is where you can either alternatively source or apply your money. Okay. And that's why we're trying to establish their value. Now, assets can be broken up into current versus non-current assets. Not crazy about these terms, but they are the official terms. Basically, short-term versus long-term assets. In fact, most of us are familiar with the term fixed assets, all right? But nowadays, if you see a balance sheet, they will break it down into current and non-current. And non-current was kind of the equivalent of your fixed assets. Okay. And the cutoff point is usually 12 months, all right? Or what we consider to be an operating cycle, all right? Most people have a financial year that runs over a year, over a 12-month period. So assets with a shorter lifespan are going to be regarded as current assets. And assets with a longer lifespan, longer than 12 months, are going to be non-current. So if I was to buy these desks and chairs, this would be a non-current asset. It doesn't mean I have to keep them for a full year. I may hate them and get rid of them. But the point is when I bought them, the intention was to keep them in the long-term running of the business for longer than 12 months. Right. So what kinds of things might involve non-current assets? What kind of non-current assets could you think a business might have? Land and buildings, vehicles. We like to refer to it as property, plant and equipment. In fact, it's our infrastructure, if you think about it, for a business, our long-term infrastructure. Right. It could also include, in fact, there's three categories of non-current assets. There's the property, plant and equipment, the physical, tangible assets, but sometimes it's also possible to bring in intangibles like royalties and patents and trademarks. Okay. We're not really going to talk about that on this course because that's quite complicated. But one of the interesting things is you can only really bring those in if you can reliably establish what their value is. In other words, at what amount, what value you should really bring them into the books at. And often you can't do that. And so you can't necessarily bring it into the books. An example is goodwill. When you purchase another business and you purchase it at a price higher than its asset value, what you're really doing is you're purchasing goodwill. You think that business is valued at more. When you start your new business, because you know what that goodwill actually cost, you can actually use that as the asset value. You've got a reliable measure. You can bring it into your books. But if you're just running your business and you think that there happens to be goodwill that you've generated, but you haven't actually paid for it, there's that idea of, you know, there has to have been a past cost, then you actually can't bring it into your book. So once again, it's one of the limitations of accounting that sometimes we can bring stuff into our books and sometimes not, because accounting tries to be objective, and so if we can't establish some sort of objective measure that people can look at and say, okay, I think that's fair or not fair, then often we can't bring that information into our books. Okay? So I'm just saying that that's there, but we're not really going to talk about royalties and trademarks and so forth. Okay? And the other class is financial assets. So if it's not a physical asset, it's a financial asset, like perhaps we've bought shares in another company, perhaps we have a fixed term deposit that we're going to keep for longer than 12 months. Those kinds of things would all be examples of non-current assets. Okay. Now, what would fall under current assets? Inventory on hand,
Materials.
bank, raw materials. You could have three types of stock, in fact, if you were a manufacturing business. You could have the raw materials, you could have the work in progress, you could have the finished goods, absolutely. You know, if you just resell a product, you just have the finished goods, but you could have, yeah, absolutely.
Debtors book.
Debtors book, okay, absolutely. So now that's a good question. Let's say I make a sale to a debtor, which basically means sell now, but you can pay me later, all right? So I make a sale for 500 Rand to a debtor. Is that asset or is that income?
Assets of future income. Asset.
Actually both. It's this idea of the double entry. We're going to learn that income tells you what you're able to generate. The asset side tells you what you actually resource. Remember we said this idea of source and application. You actually now have, or use rather, or where your funds are sitting, you have money sitting outstanding in a debtor's account. That's your asset, all right? It is something you own. You don't own the debtor, but you own the legal right to receive payment for that. And it has a retained value. Its value is 500 Rand, and you will turn it into cash by actually collecting that money from the debtor. So it is a valuable asset, just like anything else. You will use it actually as a very important source of your future cash flow. But on the other hand, you need to say, how did you go about generating that money or that additional resource or value in your business? And that's where the income account comes in. That's actually what a sales or an income account is. It doesn't tell you necessarily what's sitting in your bank account. That's what the asset account is for. What it tells you is how much you're able to generate over a time period. We'll come back to this idea of the double entry. Okay. So if any of you were confused, what debtors is an asset? Isn't it income? Yes, it's an asset that arises as a result of being able to generate income. All right. Another way to think of why debtors is an asset is because in fact you can actually sell your debtors book. I don't know if you know that. All right. That's another way to turn it into cash. Although it's a lot easier just to try and collect it from the customer. Okay. All right. Okay. What we're going to discover is that these are items that go on the balance sheet. Because the balance sheet is where I want to work out my financial position and I want to say, what do I own in assets? What do I owe against that in liabilities? Which means, what's my equity share? All right, now I just wanted to point out, when we talk about current versus non-current assets, okay, there's a very important term which we call, oh, this isn't interesting, I'm opening the wrong side.